The chairman of the Fed, Jay Powell, just sent a warning to the entire economy. He gave a 40-minute interview clarifying what exactly he thinks about the state of the economy. And his opinion matters a lot because he is the key person who takes decisions about what interest rates are going to be. If he lowers down the interest rates, then that is going to shoot the stock market to the roof because that will make access to the capital much cheaper and a lot of other factors. On the other side, if he increases the interest rates, suddenly your mortgage payments are going to be much more expensive and suddenly you won't be able to afford your dream house because the mortgage payments on that are going to be much higher than you can possibly afford. And that's why let's dive deep into what exactly Jay Powell said and clarify his opinion about the state of the stock market and how that is going to impact the market. If you're ready, give this video a thumbs up and let's get right into it. Remember back in the days, just a few months ago, or probably the last or the end of the last year, Jay Powell or the Fed says that we're expecting to lower the interest rates. Now, at the end of the last year, the Fed actually lowered down interest rates. Why? Because they were expecting that inflation is going to go down. And on the other side, we're expecting a mild recession, which is why it actually makes sense to lower down interest rates because we want to avoid any kind of a recession. But the only reason we can do that is when we are confident that prices are stable. What is the final goal of the Fed at the end of the day? Price stability and maximum employment. If we don't have any kind of price stability, there is no business. There is no confidence in the US economy. There is no money going in. There is doubts in the US dollar, which is why this is the first priority. The second priority is full employment. When everybody is employed and everybody is working, so if companies have money to actually build and create those jobs, then the GDP is going to grow. So that is the mentality that the Fed has. And that was basically the trend starting from the end of the last year. And if you look at all the expectations of all economies, when Trump is going to become the president of the United States, he's a pro-business person, which means that he's going to encourage the economy or the Fed to lower down interest rates to further grow the GDP. That was the logic. But what happened at the end of the day? The absolute opposite. Jay Powell says that the Fed will actually keep the interest rates on hold until there is clarity. Apparently, it turns out that the Federal Reserve get their news just as much as anyone else in the economy from Trump's tweets. Nobody actually for a fact knows what are going to be the final tariffs. You know, you were actually watching the news and you get your news, oh, today we have tariffs on this country and X percentages, and then tomorrow there is an exemption, and then after tomorrow, you know, there is a different tariff. It seems like the Fed has no inside information in order to make decisions prior to everyone else. And that's why even the Federal Reserve said that they're actually shocked and those tariffs are significantly more than they have expected. And because they don't know what's going to happen with those tariffs, they cannot properly plan. And because the goal of the Fed is price stability, how can we possibly plan price stability if we don't know what are the policies are going to be, if we don't know what are the rules of the games are going to be? And that's why the Fed is like, we're not going to lower the interest rates, which means that maybe in 2025, even by the end of the year, the expectations of 3% interest rates are not happening. And that will have a very serious implication on your portfolio, on the economy, and pretty much on your entire life. Now, secondly, the problem is that because those tariffs are so uncertain, tariffs will certainly cause price hikes. Like whether you like that or not, that is basically a fact. Let me just give you an example. So we have a 10% baseline tariff. Everything will be imported is going to increase in prices by 10%. So what the Fed hopes for a fact is that there is going to be a one-time price hike so that the entire market would adjust to those tariffs. And then after that, inflation will go down to the goal of 2% annually, which is actually normal. But the problem, we cannot even plan that because we don't know whether the tariffs are going to be. Just recently, I found out that the tariffs on China are going to be 245%, and then there is an exemptions on laptops and smartphones, but there are tariffs that the White House is right now working on the smartphones as well. So how can we possibly expect a one-time price hike when we don't know what kind of tariffs are going to be there? Now, secondly, there are reciprocal tariffs, and those reciprocal tariffs are a tool to negotiate with other countries. So what are going to be the final tariffs on those countries on whom the US has reciprocal tariffs? We don't know. And we might know that in 90 days from now, or maybe longer than that. So if prices would rise much faster and much higher than the Fed expected, then there is a real possibility of actually raising the interest rates within this year. Just imagine what kind of implication that is going to have on the entire economy. These are not my words. I'm simply reporting to you what the chairman of the Fed says and what potentially he says could actually mean to the economy. Because the chairman of the Fed has to be very careful with his words. Whatever he says is going to have a direct implication on the market. If he says something negative, then that will crush the stock market. If he says something positive, then the stock market is going to go to the roof, which is why we have to kind of read between the lines and understand what exactly he's trying to say. He also made it clear that the GDP growth are going to be much lower than expected. If you go back to the March, they have already lowered down their GDP forecast from 2.1% to 1.7%. And in the last interview, he made it clear again that the new forecasts that are going to come for the Q1 of 2025 are going to be much lower than they expected, which means that the economy is slowing down. And that slowdown in the economy, if it continues and it turns into negative GDP growth, then it could turn into a real recession. Now, another thing that you have to understand that even though that we have so many news about the tariffs, nobody have actually seen the real implication of the tariffs because they will not come immediately. Like when you see the headlines, oh, we have tariffs of 10% or 20% or 100%, they will not have a direct implication the same day or the next day. The real implications are going to come 3 months from now, 6 months from now, a year from now. Why? Because if you're a business and you first of all, you have a stockpile of your products in your backyard, so you can still sell those products without tariffs. Secondly, when they announced the tariffs, a lot of those companies started bringing a lot of those goods from China and Vietnam and the rest of the world. So there is a lot of stockpile in the United States right now that can be sold, and there was no tariffs on those goods. Now, thirdly, those stockpiles are going to be over sooner or later. So the next shipment that will come from China, for example, and it will be taxed at the border at 245%, that's when you will actually see real hikes in prices. Do you see the problem? When will that happen? A few months from now? 6 months from now? It will be different for many businesses. So a lot of businesses will do their math. They know that if they actually increase prices to a certain extent, consumers won't actually buy their products. Maybe there will be some demand out there, but overall, if demand is going to go down by 90%, you might have actually to close down your business. Because in business, like you have two types of costs. You have like variable costs and you have fixed costs. Fixed costs are your rental, for example, or your employees and so on and so forth. And variable cost is, for example, the cost of your products that you're actually bringing from China or Vietnam or any other country. So if your revenue is going to go so down that you can't even cover your fixed costs and it makes no economic sense to keep sustaining your business, you might actually have to close down your business. So over time, unemployment could actually rise. And that's another thing that the Fed actually hinted slowly, that unemployment could rise. And that will put the Fed in such a scenario where on one side you have unemployment rising slowly, on the other side you have inflation rising slowly, and you actually have to take opposite decisions in those scenarios in order to fix the problem. Lower interest rates in order to lower down unemployment, or hike the interest rates in order to lower down inflation. What exactly are you going to do? So the Fed for now has no idea what they want to do because they have no idea what's going to happen. But what they know for a fact is that there is a real possibility of unemployment is rising and GDP growth to actually going down. So a recession is still a real possibility. You can also see that in the Consumer Confidence Index. The Consumer Confidence Index is how people feel confident about the future of the economy. And that is extremely important. Why? Because the more you're confident about the state of the economy, the more you're confident to spend your money. If you are not confident about the state of the economy and you're worried that you might lose your job, you're worried about prices, you're worried about everything, your spending goes down. So that kind of slashes down the purchasing power of the population, which is going to become a self-fulfilling prophecy that will drive the economy into a recession and economic crisis. And look at the consumer confidence index. It is as low as it was back in 2020 when we had one of the greatest crises in the history of the world, which was the pandemic of 2020. But we don't have a pandemic. We don't have a disaster. We don't have anything like that. We simply have the greatest trade war that humans have actually started. You can also see that in the consumer sentiment. Now, consumer sentiment index is basically what people feel about the state of the economy. And right now, it is as low as it was back in 2020. What happened in 2020? The Fed literally hiked the rates from almost 0% to as much as 5.5%. And that made access to the capital so difficult that a lot of companies started declaring bankruptcy one after another. Remember, we had like a period of so many crypto companies literally just watching how their stocks going to zero and closing down their businesses. But we don't have interest rate hikes right now. We don't have inflation of 9% like in 2020. So why is consumer sentiment is so low? Again, because of those tariffs that are creating so much uncertainty about the state of the economy that consumers and businesses are afraid to spend. The Fed was also asked if the Fed is going to intervene if the stock market keeps crashing. You see, the market has been crashing tremendously, and all the gains that have been made over the last year have been disappearing over the last couple of weeks. In fact, the market have actually crashed much more than that, but it stabilized slightly. So that raises the question, will the Fed, just like in 2020, intervene and send us free cash flow into the economy to save it? The Fed said, nope, we're not going to do that. Not this time. We have done it once. We spent trillions of dollars. Not again. You gotta save yourself some other way. The Fed cannot keep just helping the rich people. The Fed should save the poor people. The Fed should work for the middle class. Well, apparently, the Fed is not going to save the stock market, but let's hope that the stock market won't keep crashing because of this uncertainty. But if it even crashes, not all stocks crashes. And secondly, even if it crashes farther, we know for a fact that there is going to be a deal made between all those countries, and that is basically an opportunity for investors to keep buying some of the greatest stocks in the market for such a discount that they will end up making more money than they can possibly predict. Now, in 2020, it happened so fast that most people couldn't even realize what exactly has happened. Like, it's like, hoppa, one day and the stock market crashed and recovered, and nobody kind of realized what exactly has happened. Wait, the market crashed? I didn't even realize how the market crashed in 2020. But right now, it is happening slowly. It is happening bit by bit. And that presents a unique opportunity to think calmly before you actually start investing and spot those opportunities. So this is one of the greatest opportunities, so do not miss it. And if you don't know how to pick stocks like a professional investor, then you have to go to the first link in the description and check it out. But if you know how to do that, you should take the best advantage out of this opportunity. Thanks for watching, and I will see you in the next one.